Sam Altman drew a line. $1 trillion or nothing. That's the price OpenAI wants the day it goes public. No company in history has ever justified a tag that big while losing money this fast. And this is the part that should stop you cold. OpenAI is on track to burn $27 billion this year. Next year, closer to 63. But that's not even the strange part. Over on the secondary market, the quiet corner where employees sell their shares, something strange has already happened. Anthropic, the company behind the Claude chatbot, has passed OpenAI. Anthropic trades near $1 trillion. OpenAI sits around $880 billion. 2 years ago, most people had never heard Anthropic's name. So how do you price a company that has no stock price? That right there is the whole game. Hey, it's Finn. This is Signal Tomorrow, where we grab the biggest AI headlines and pull out what's actually true under all the noise. If that's your kind of thing, do me a favor and tap subscribe. Alright, here's today's puzzle. Pricing a company with no stock price. It isn't one number. It's three and they don't agree. Start with the basic problem. A private company has no ticker symbol, so its worth isn't a single number. It's three numbers and right now they argue. 1. The funding round. That's the headline price a company gets when it sells brand new shares to big investors. 2. The secondary market, where insiders sell their old shares to whoever's hungry enough to buy. 3. Prediction markets, where total strangers bet real money on when the company will go public. 3 machines. 3 answers. One idea sits under all three of those machines, the revenue multiple. It's a blunt little tool. Take what a company earns in a year and multiply. Boring public software companies trade at maybe 5 to 12 times their revenue. The AI leaders, 25 to 50 times. So at $1 trillion on roughly $25 billion in sales, OpenAI is priced near 40 times a single year of revenue. 40 times. That math only holds if OpenAI wins the entire category. What is OpenAI really underneath the headline? In March, it closed the biggest funding round ever recorded, $122 billion at an $852 billion valuation led by SoftBank. The revenue's climbing fast too. About $20 billion at the end of last year, $25 billion by February. That part's real. But the gross margin is only about 33 cents on every dollar. This is a rocket that runs on cash. Here's the thing about that cash. OpenAI isn't expected to turn cash flow positive until 2030. Read that again, 4 more years of losses. The burn jumps from $27 billion this year to $63 billion next year. More than double in 12 months. So when the skeptics say nobody has ever justified $1 trillion price tag while bleeding this hard, they've got a point. The bulls have an answer. We're getting to it. The bull case comes down to one word: growth. Nothing this size has ever grown this fast. OpenAI added roughly a quarter to its revenue in just 2 months. That's not a mature company coasting, it's one still speeding up. More than 1 million organizations now run on its tech. If that curve holds, 40 times revenue looks cheap. If it cracks, $1 trillion looks insane. Both can be true right up until they aren't. OpenAI isn't even the most valuable AI startup anymore. Anthropic is. It raised $65 billion at a $965 billion valuation in May. Then its revenue did something that barely looks real, about $9 billion at the end of last year, $30 billion by March. That's a 230% jump in a single quarter, much of it from coding tools. One IPO researcher called the rise unprecedented. And he wasn't exaggerating. This next part flips the whole story. On paper, the two are neck and neck, 852 against 965. But on the secondary market, Anthropic trades near $1 trillion, while OpenAI sits near 880. Why the gap? Scarcity. Anthropic's staff have had almost no chance to cash out, so sellers are rare and buyers are frantic. Demand for those shares jumped 650% in a single year. OpenAI had the opposite problem, more people selling than buying. Then there's a third voice, prediction markets, where people bet real money on what happens next. And they flatly disagree with each other. On Kalshi, traders put about 88% odds on OpenAI announcing an IPO this year, and they bet it lists before Anthropic. On Polymarket, it's flipped. The crowd there gives Anthropic the better shot to go first. Same event. Opposite calls. The whole split comes down to fine print, what actually counts as going public. So which of these signals should you actually trust? The honest answer is none of them alone. The funding round is slow, and it was negotiated months ago. Secondary prices are thin and jumpy. A handful of trades can swing the whole number. Prediction markets move on how a contract is worded. The trick isn't picking a winner. It's watching where they split apart, because the gap between them is where the real story hides. Two more names round out the picture, and both cut against the panic. Start with Databricks, the odd one out. It's the only company in this whole pipeline that actually makes money. $5.4 billion in revenue, growing 65%, throwing off real cash. It sells data software and rides the AI wave without ever training its own frontier models, the giant systems everyone else is racing to build. Its CEO flatly refused to list this year. He called 2026 a terrible time to go public. Look, the name that matters most this week isn't even an AI lab. It's SK Hynix, the Korean company that makes more than half the world's high-bandwidth memory. Those are the specialized chips that feed NVIDIA's processors. Right now, it's listing on Nasdaq, raising about $29 billion. That's the second biggest US market debut in history, behind only SpaceX. Trading starts July 10th. And it's the first real test of whether investors still want the AI trade at all. So why does OpenAI keep holding out for $1 trillion? Because Sam Altman won't blink. According to the New York Times, his advisors handed him a choice: take a lower price and list this year, or hold the line at $1 trillion and wait until 2027. He reportedly treated any discount as a non-starter. And when the delay reports leaked, SoftBank, OpenAI's single biggest backer, dropped as much as 14% in Tokyo. $38 billion of value. Gone in one trading session. This is our read after going through all of it. These aren't three numbers fighting to be right. They're three different questions. The funding round asks what insiders negotiated months ago. The secondary market asks what one scarce share is worth today. And honestly, prediction markets are just the crowd guessing at tomorrow, which means OpenAI's trillion isn't really a valuation. It's a bet that one company swallows the whole category. SK Hynix on July 10th is the tell, a live referendum on the whole AI trade. A strong open says the money is still hungry for anything with AI in the name, and the OpenAI to Anthropic pipeline keeps flowing. A weak one and the window slams shut. Then watch two things. First, whose secret filing goes public first, which settles that Kalshi versus Polymarket bet. Second, whether Anthropic's $47 billion run rate survives the auditors. That's its sales stretched to a full year and the least verified number of them all. How does OpenAI justify $1 trillion? The honest answer is, it doesn't, not with today's numbers. It justifies the price with a story about tomorrow. A future where it wins so completely that 4 years of losses just stop mattering. Maybe that's vision. Maybe it's the sound of a market topping out. The traders and the betting crowd are already leaning one way. We'll be right here, watching which way the real money goes. If this made the $1 trillion puzzle finally click, a like genuinely helps the channel. Subscribe and you'll catch the next story the day it drops. See you in the next one.